There's some analysts that are saying that the time to buy Roku is now, but the question is, why exactly are they saying that? Well, that's what I'm going to cover in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys? And this story is well documented, and you guys already know, especially those of you who've been following Cathie Wood's career. She has been a big bull on Roku, but the problem is she's bulled this thing all the way down. And what do I mean by that? Well, this stock is down over 70% year to date, which has been an absolute soul crusher investment for anybody that's held on to it. So the question is, why would anybody want to invest in this name that has tumbled so much year to date? And it could potentially go down even further with the reduction in ad spend in the digital space. Well, D.A. Davidson analyst Tom Fort has said that he believes that Roku shares are attractive after their big decline this year. So effectively what he's saying is, guys, buy the dip. And he put a $130 price target on this stock, which is effectively a double from its current share price. But the question I have is, why is he so bullish on this name? What is his thesis? Well, you can see he says in this article that the long arch of consumers switching their 40-hour TV watching to connected internet-based TV remains strong. So effectively what he's saying is that the secular demand is there, and so there's a secular tailwind for a company like Roku. He's also confident that the company's TV operating system will retain its market share due to its ease of use for customers. So effectively what he's saying is, not only will the movement to digital continue, but of the people that operate in the digital space, Roku makes it easy, or at least in the free digital space, Roku makes it easy, and thus they'll continue to hold a significant amount of market share. And I don't disagree with them, especially considering that they're just putting it for free in new TV systems anyways. So you're just going to get Roku by default. And this is what he means about his secular tailwind. I agree, the thesis remains the same. Pay TV is on the decline and people are switching to digital. So fiscal year 2023 is expected to be the first year where more people are not using legacy TV and they're now using more digital. And that's just going to continue to decline as time goes on. The market is shifting. But despite that, there's one item that the analysts didn't actually mention, and I do believe it's a big bull case for companies like Roku. I believe that TV and ad budget spending has not grown in line with the time spent streaming by consumers. And so this is a slide that Roku actually releases where they're saying that the budgets have just not grown in proportion. And eventually this will be a strong catalyst for these guys. It just takes some time as more and more advertisers get accustomed to video advertising for free direct-to-consumer mediums, the more you're going to have this positive flywheel effect happening. But now here's the thing. I actually don't know how to value Roku, and this is what's made me shy about buying this name. And I'm going to show you two scenarios in this video of valuation possibilities for Roku. One is kind of like a meh base case, and the other one is a screaming buy. And so let's get right into it. So you can see here's my base case. I'm effectively saying that Roku's profitability is only going to slightly increase as time goes on. So right now I'm forecasting profitability, so free cash flow as a percentage of revenue, from their 2021 actual results of approximately 7.3% to 7.5% in fiscal year 2022, and it only goes up to 9.5% by 2031. And so based on that base case expectation, using a valuation multiple of 20 times earnings, I believe that the company's worth approximately $96 per share. Call it an even $100 per share. Well, based on the current share price of $67, I would want this company to come down to at least $50 per share before I bought it. And that's kind of what my base case is saying. But I think that I'm being very pessimistic here, and I think people who are more excited about the digital ad spending space and are excited about all the manpower that's going into the research and development of this business believe that this is going to become more profitable than what I do. And this is where I think they're kind of going at this. This is what I call the analyst scenario. So profitability is increasing rapidly. So obviously there's a case for this, because in 2020, the profitability or the free cash flow as a percentage of revenue went from negative 5.6% to positive 7.3%. So in 2022, it only going up to 7.5% based on my expectations. That's more a function of the economy right now and things slowing down. But what happens when things go back to normal, say in around 24 or 2025 and beyond? And so notice that profitability, that free cash flow as a percentage of revenue is increasing substantially to the point where it gets to around 30%. And the reason why that could happen is that as more and more advertising dollars go into the direct-to-consumer free TV space, well, they're going to be competing with higher rates. And so that is all down to the bottom line, because the cost for showing this is all the same for Roku. And notice that when you value the company using this sort of methodology, using a 20 times valuation multiple for the free cash flow per share, I'm valuing the company at approximately $240 per share. So compared to the current share price of $67 per share, it's a screaming buy. It's considerably undervalued. But the one thing that I do want to point out to you guys, for both of those scenarios, you have to take a position on what you believe stock-based compensation as a percentage of the revenue is expected to be, and then take that off of the free cash flow to come up with a valuation. And I actually did that for you, which I will show you next. The first thing that I want to remind you of is that approximately 80% of the watch time on this channel is from people that are not subscribed. So if you have an opportunity, guys, smash that red subscribe button. Now let's go into my valuation, taking into account that stock-based compensation. So effectively what I'm saying is right now, stock-based compensation as a percentage of revenue is approximately 7%, which is where it averaged in 2020 and 2021 when you take those two into account. It might actually be lower in 2022. But 2023 and beyond, as our revenue increases, I don't believe that they're going to increase stock-based compensation at that heavy of a level. And so I'm actually bringing it down as a percentage of revenue. And so where does my valuation sit as a result of that? Well, you can see that using a 20 times earning multiple, my valuation once again is around that $100 per share, just a little bit lower than what I showed you earlier of the base case. So I believe the company's trading at approximately 70% of its intrinsic value. Now, I might actually be a buyer sub $45 per share. But the question is it a pipe dream that the shares will actually decline from $67 per share to approximately $45 per share? Well, thank goodness for cash secured puts, because I don't have to care and I don't have to wait, because I can just see what the $45 cash secured put is yielding me today. And you can see that the January 19, 2024 $45 cash secured puts with a current premium of approximately $9.50 reflects an annualized yield of approximately 15%. It also gives you a solid net purchase price of approximately $35 per share. So I might actually finally be a buyer of Roku at a strike price of $45 per share and a net purchase price of $35 per share. Talk about dumpster diving when the stock is collapsing. That's the way I like to do it. Now, you might believe that Roku has risks inherent to it that are hard to get over. One of those risks is the fact that everybody's kind of entering into the free TV space right now. Netflix is launching a service, and they just partnered with Microsoft. And I do believe that Paramount is also going to do the same thing. And Warner Brothers is probably going to do the same thing as well. And Disney. And so this space could be very, very crowded. So it might be a reason why you don't want to invest into Roku. And I totally get that. But here's the thing. On the tracker that the Patreons get access to, Roku is just one name on the list of 28 companies that are currently trading below 75% of their intrinsic value. And you can see that Roku's pretty low on that list. So there's companies quite a bit cheaper. One of them you can see at the very top is Alibaba. Alibaba, I'm valuing that company at around $300 per share, and it's currently trading at $94 per share. So it's trading at less than 30% of its intrinsic value. And there's a whole slew of names in between there as well. But the question is, how do you get access to that list? Well, you can access that list at the lower tier of the Patreons. I make it very cheap for you guys. And if you want to join us for an epic live presentation every month, join us on the upper tier of the Patreons. Now, in this video, I did mention Warner Brothers potentially entering the free TV space. Now, one of the things about Warner Brothers that you guys got to be well versed in is exactly what the thesis is. And this is a thesis that's being followed by many intelligent super investors like Seth Klarman, who's one of my personal heroes, and I actually break down his position in Warner Brothers right here.